Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. John Authers is with us. He is Bloomberg opinion columnist. He has been writing a lot about not only the yen carry trade, but a lot of the volatility that we've been seeing. It's always good to have the chance to visit with you. How are you putting this into context right now? Is this something that the BOJ started when it tightened? Is this the consequence of the Fed maybe altering its strategy a bit, or is it maybe a little bit of both?
It's a bit of both, and you need to throw in, because the Magnificent Seven stocks, the big internet platforms, were virtually being treated the way that treasuries normally are, as infallible, risk-free investments that people around the world wanted to invest in. I think you need to throw in the nervousness about AI that really got going in the last couple of weeks as well. There were a combination of events that allowed, that somehow or other triggered a sell-off. I think ultimately the issue is about central banking coordination. I've made the analogy many times with mountains, and this was something the chief economist of the Bank of England, Hugh Pill, made this analogy quite a while ago now, that the shape. Are we going to have a table mountain where you keep rates at the same level for a long time and then descend, or is it going to be a Matterhorn? And the point of that is that the descent from a mountain is much more dangerous than the ascent. Far more climbers get killed going down than going up. And it's particularly crucial when you're going down to coordinate. Everyone needs to be roped together. You've got to coordinate your way down the face. I think the analogy with central banking is very good. Last week, you saw the Fed do nothing, the BOJ hike, and the Bank of England cut. That is a recipe. I'm not saying they all have a prime job to their own economies, but when you have that degree of lack of coordination, there are going to be problems.
So the Bank of Japan has been looking at inflation in that country well above target for quite some time. Are they guilty of a policy mistake? Did they wait too long? Did the BOJ fall behind the curve? And I know that may seem kind of harsh criticism for a country that's been mired in deflation for 3 decades plus now.
No, I wouldn't accuse them of that. Certainly at the moment, if people are complaining about anything, it's that they shouldn't have hiked even to the princely rate of 0.25%. Now, there are people who are saying they're being too hawkish. I think it's obvious, to some extent, you got earnings figures earlier this week showing that people really are beginning to get wage rises in nominal terms in Japan, which really does. That's exactly what the BOJ has wanted to see happen. You want to see the kind of economy ticking over in a way that it does when there is some inflation out there, and Japan has to return to some kind of normal financial capitalism where the interest rate acts as a discipline on it. So I think there's a lot of problems with messaging. There's all kinds of things about the exact circumstances in which its move happened last week. I don't myself think that they waited. That's a fair criticism.
So this reflationary move that we've been seeing is due to some degree by a stronger dollar, right? We can't ignore that fact.
With regard to Japan?
Yes.
Certainly, yes. And I think that's one of the points which I think will go into abeyance for a few months, but then will come back in a very big way, is the dollar. I think most things at the moment point to a weak dollar through the election, weaker dollar than we've had through the election, mainly because the Japanese carry trade is obviously not a one-way bet anymore, and the more that the carry trade comes off, that will tend to weaken the dollar. And if the direction of interest rates in this country, in the US, is downwards, then that means a weaker dollar as well. Come the election, more or less everybody I know thinks that a Trump 2.0 would mean a higher dollar, even though he wants a lower one. Tariffs plus fiscal boost equals higher rates,
higher deficits, lower taxes. That's a recipe for higher inflation.
It's a recipe to get the economy going quite nicely for a bit, but it's also a recipe for higher rates, higher inflation, and a higher dollar. So that a few weeks ago it was tacitly being assumed as about 100% probability that we would be getting Trump 2.0. Now we're back to a coin flip, and because there are other things going on, it's hard to read much from all the amazing politics of the last few weeks into the markets, but that will come back.
So you mentioned the unwind of the carry trade. The number that I heard was about $4 trillion in total size. I mean, I don't know where that is being acquired. Do you have a sense of where we are in this unwind right now? Are we pretty much halfway through it? Is there a little bit more that we need to experience?
I mean, nobody can know, because it's not like there are carry trade funds with publicly available assets under management. My sense, however, this is my favorite rule of thumb: the Mexican peso yen carry trade, i.e., borrowing in yen, parking it in the Mexican peso, according to our Bloomberg's index, has gained more this decade in total return terms than the S&P 500 has. And there are times when I just believe in Occam's razor. That's crazy. There must be further to go. Andrés Manuel López Obrador came in regarded as this dangerous president who might crash the peso. At the moment, he is still the only Mexican president since they allowed the peso to float who will leave with the peso stronger than when he arrived, which again makes very little sense. It's because so many people are pumping money into the carry trade, which involves buying pesos. I think there is quite a lot further to go.
Is it incumbent upon a central banker to look at the way in which their currency may be used as a carry trade and building leverage in global financial systems? Do central bankers, as a result of this exercise, need to be on high alert for this type of thing happening in the future?
I think they always should be. I think there were many mistakes in 2008, but at that point it was more the Brazilian real. But there was a massive yen carry trade then, which crashed in really spectacular fashion, and that was definitely a contributor to the market conditions that brought down Lehman. The carry trade peaked and went downwards a few months from memory before Lehman went down. So, I mean, central banks are morally required to take lots of things into account, and they will be criticized by people like me when they miss something. So it's a rotten job on that level. But yes, the carry trade is a ubiquitous way of accessing leverage, which is very hard to measure, and it looks as though it has been allowed to go too far once more in the last couple of years.
So we've been talking about financial market dislocation. At what point does it tip over and become economic dislocation?
I think it becomes that it moves on to that level if you have an emerging market that actually moves into serious trouble. That's the script from previous decades, which does, I have to say, look much less likely because so much more emerging market debt is in their own currency now. So the kind of domino effect you got in the late 90s, the Asia crisis, is much less likely. And the other way is if you have a really major institution come into trouble. Okay, that's how markets really tip into a major economic crash. Again, I'm not saying it's not going to happen. I think it's less likely than it was in 2008.
John, it's always a pleasure. John Authers from Bloomberg Opinion here on Daybreak Asia. Thanks so much. Let's get to our guest on markets. Berkeley Belknap is with us, head of U.S. Advisory Portfolio Management at Franklin Templeton, joining us from the Bay Area. Berkeley, thanks so much for being with us. I'm curious about what you have been hearing from clients, let's say, in the last couple of days. It was very interesting data point yesterday from Alight Solutions. The 401k index that they monitor saw the greatest large cap U.S. equity outflow for quite some time, about 60%. Were a lot of your clients very, very nervous, and was there heavy selling?
Yeah, I think this is one of those times where panic sets in and where you see a real disconnect between what's going on in the economy with the real economy versus what's happening in the market. And, this is one of those times where there's been a fair amount of panic. But when you look at economic fundamentals, they still look pretty sound. And, our view really of the global economy is that, yes, some things have moderated, leading indicators have moderated, the rate of growth is slowing, but we still see reasonable growth expectations. And, we really pay attention to a broad set of leading economic indicators and try to focus our attention on patterns of change in the direction, level, and the rate of change. And these indicators have moderated, but they still continue to suggest really reasonable growth. So, if we incorporate risks on top of this, we continue to maintain a measured view that growth is constructive but growing. So we look at those when we focus on corporate fundamentals and see those, as still really, quite positive. And as economic growth moves more towards historical trends, we'll probably get some relief from interest rates when the Fed starts their cycle, and that will help earnings breadth to broaden. So we don't have really a pessimistic view from the recent activity, and really tried to keep those two things separate, the economy from the actual market activity.
What about, the extent in which it's becoming a bit trickier these days to watch these economic indicators and figure out the recession risks, because markets seem to be getting it wrong, to your point about how it is still growing, maybe not as quickly. We heard how Claudia Sam, she said, some of these economic tools are being skewed by disruptions in the past 4.5 years. So is it becoming a bit cloudier in terms of getting these projections and getting it right?
I think it is. And the element of COVID, really skews sort of the way to look at history and the way to look at some of these statistics over time. The SOM rule is 11 for 11 in predicting recessions, but even Claudia Sam has said, hey, this may not be exactly the same situation given what happened to the labor market during COVID. So, for example, when we look at the unemployment report and it's being compared to early stages of previous recessions, we don't see it quite as worrisome because many of the labor market indicators have merely reversed their post-COVID gains. And now they sit at levels closer to the pre-COVID equilibrium. So we see the labor market as definitely slowing its growth, but still at a healthy level.
I want to talk about one of the industries that seems to be very challenged at the moment, media. We heard from Warner Brothers Discovery after the bell. The company has written down the value of its traditional TV networks and posted a charge as a result of that to $9.1 billion. Our own Chris Palmieri was talking about the possibility that this is a watershed moment. And then early today, we heard from Disney, it's somewhat of a mixed picture. So weakness in the theme park business, and then we did have Disney posting its first ever profit in streaming. Talk to me about how you see the media industry broadly at this moment in time.
It's really going through probably the largest change it's ever been through in its history. And the traditional television network model is pretty much finished. And, we now pretty much only use streaming services. So you're going to continue to see those larger companies write down those businesses and focus their efforts more on the more efficient app-based products. So it's probably an industry that's going to be suffering in terms of profitability in the near term, just based on this conversion. And it's it's an industry also that if you look at what is actually streamed onto TV has really changed over time from sort of the traditional, TV productions into more live events. And we would expect to see them really continue to focus on live events and less expensive productions.
Do you see this continued rotation out of growth into value? Because it didn't seem to last very long based on what we saw on Wall Street overnight.
Yeah, I think that, growth has been just so dominant. And, when we look at sort of what's happened this year, right, and you think about how much of the performance has been in the Magnificent Seven stocks, or just even the tech industry and growth companies, and the outperformance, has been so significant. And even though we've given back about a third of it thus far with this rotation, growth stocks are still so far ahead. And, the one thing I'd say, though, before everyone jumps ship and moves into value is there's a reason that growth has outperformed. And if you look at those, even those Mag 7 stocks and the earnings that they've produced and the rate of the earnings growth, it's really justified those valuations. And so, at this point in time, when you look at earnings growth in those Mag 7 stocks, it's still extremely strong, but we do expect breadth to widen here, especially as interest rates come down. So we would expect to see certain sectors where value companies really prevail to perform better looking at the rest of this year.
We'll leave it there. Berkeley, thank you so much. Berkeley Belknap from Franklin Templeton here on Daybreak Asia. Clayton Allen is director for the United States at Eurasia Group. He joins us from Washington, D.C. First of all, before we get into the politics of this, how do you assess the choice of Walls?
I think the best way to describe Walls is a safe pair of hands. This is not the choice that's going to blow anyone out of the water. It's not going to really create this massive new shift in Democratic appeal. But it's also someone who probably isn't going to have too many downsides for Harris. He's moderate. He's from the Midwest, represents an ag state. He's a lot of things that Kamala Harris just isn't. So it complements her appeal in a lot of ways. It is a little bit of a gamble on the campaign itself. It's obvious they're betting that they're getting strong enough that they don't need Shapiro's boost in Pennsylvania.
He's also seen as someone that's favored by progressives, but to many Americans, a relative unknown. Correct me if I'm wrong. We are 3 months away. Is this enough time for him to introduce himself to voters?
No, I think you are 100% correct. And the thing is that they have about $425 million to spend to make sure people get to know the version of Tim Walz that they want people to know. Vice presidents are never the prime draw. It's they're always the backup singer. They're always the opening act. They're never the person that's selling the tickets to get people in the door. By the same token, they can't be terrible. You can't have a terrible bass player in your band and be successful, but nobody's there to see the bass player. Tim Walz is going to become very well known. In fact, you were already seeing this really massive, pretty coordinated rollout across social media from both the Harris campaign as well as other Democratic surrogates that are all trying to put forward the preferred image of Walz, this moderate kind of dad figure, a kind of, again, a safe pair of hands, someone who is moderate, approachable, friendly. And in a lot of ways, they're trying to position him as maybe a contrast to J.D. Vance. So
that kind of anticipates the next question here in terms of the Trump-Vance campaign. What type of challenge are they now facing maybe that they weren't before, if you assume that the conventional wisdom was that Josh Shapiro would be put on the ticket?
I think the conventional wisdom of Shapiro sort of was, I think in some ways, a little bit bigger of a risk for Trump. I mean, and for Republicans in general. I think that they view Shapiro as an inbuilt advantage for Harris in what is at this point likely to be the tipping point state, the state that decides the breakdown of electoral college results, the one that's going to push either side over 270. I think that the Trump campaign now faces a bit of a pivot. They have to sort of reframe what Vance's appeal is and put him more as a counterpart or reframe him a little bit to directly offset Walz's appeal. The other thing is Vance right now is the most vocal person in the Trump campaign. Trump has really kind of backed away from campaign events. He only really has one scheduled in the upcoming week, and that's in Montana. So Vance is taking the lion's share of the public attention and media hits that the campaign's putting out right now.
It seems like neither side is making much headway as well with black voters. Does this shift the calculus?
So I think that the Harris side is making some headway. You're seeing really sharp increases in voter enthusiasm, especially among black voters. There's indications that there are many more likely black voters. There's a couple of electoral analyses now that are out saying, look, this is a big deal because the more that you can increase potential turnout, the more states you possibly put on the map. I think that this is something that both sides are really very, very aware of. Certainly the Trump campaign has an explicit strategy of trying to divide parts of the Democratic base by appealing to black male voters between the ages of 18 and 35. Susie Wiles said that verbatim. And I think they're going to continue to do that to try and mitigate or minimize that increase in voter enthusiasm among black voters.
When President Biden was atop the Democratic ticket, there was a lot of concern being expressed from members in Congress, whether the House or the Senate, talking about the vulnerability in some of those down ballot races, which is to say anything below kind of the presidential ticket. What does this do for Democrats' hope of maybe holding on to the Senate and picking up a few seats in the House?
I mean, mechanically, just as the top of the ticket gets tighter, as the Harris campaign looks more competitive, it boosts down ballot races because the ultimate effect is to raise voter turnout across the Democratic sort of spectrum. And higher turnout benefits every Democrat that's on the ballot. I think the other side effect is that you now have Democrats who don't have to worry about explaining away top of the ticket or a presidential candidate that people really weren't that excited about. It takes away a big headwind for a lot of these races, and I think it improves Democrats' chances, certainly in both the House and the Senate, though I'd be remiss not to note that the Senate still looks likely to go Republican just by virtue of the fact that if Democrats lose one of the races that are up right now, especially one of the two really close ones in Montana and Ohio, that gives Republicans a straight-up 51-seat advantage.
One of the things that also came up after the ticket was confirmed is Walz's connections with China going back decades. Do you think this in any way informs what could be the approach to China going forward?
I really doubt it, to be honest. I think that Walz is going to be a lot like Biden was in 2008 and Harris was in 2020. Someone who is there to complement and to bolster the chief executive, but who is not there to set the direction of policy. It's a governing partner in a lot of ways in that the vice president goes and delivers the message of the administration. But I don't expect that Walz is going to have a huge direct impact on the actual shape of that policy. That will be dictated by Harris and by her close advisors.
Clayton, thank you for making time to chat with us. Clayton Allen there. He is director for the United States at Eurasia Group on the line from Washington, D.C. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.